Okay,
Record
let's
and in the cloud, please.
okay, I just click on record, so I think hopefully it
Okay,
should work.
that's okay.
Okay, perfect. So let's start. So welcome to this session on inflation. So I'm Fabrizio Zampolli from the BIS, and I will chair the session. We have very rich and interesting agenda. So all the papers today are on inflation expectation, and inflation is clearly now a very hot topic in Latin America, as inflation has reached new highs since the start of the pandemic. And understanding inflation, how the risk evolve, and so on is clearly an important task for central banks. And indeed, all the papers today have been written by central banks economists. So before we move on, let me remind the presenter that each of you has 20 minutes for your presentation. My job as a chair is to make sure that you stick to the time. So during your presentation, I will let you know, that I'll try to show you on a piece of paper the minutes remaining on. If you don't see the paper, I will intervene. So let's start with Barnabe from the Central Bank of Chile. Barnabe, the floor is yours.
All right, thank you, Fabrizio. I'll start sharing. So you should be able to see my screen now. Okay, all good. I have a timer here also, just in case. So, okay, thank you for the introduction. So what I'm going to present is joint work with Mario Canales, who is in his graduate program at UCLA Anderson now. And this work is about uncertainty, risk, and price setting. Uncertainty, broadly speaking, and we'll see how we make that operational. And we know there's a literature, a large literature now that has established the role of uncertainty as a driver of important economic variables, mainly in activity, investment, and so on. And there's a consensus that there are negative effects on economic activity, but for prices, evidence, we have a review, a thorough review of the literature, and the evidence varies considerably across economies, and even within economies. For the US, it varies across periods. And theory is also ambiguous, and I'm going to mention that shortly because I think it's interesting. And this is important because if you think about monetary policy, if you have situations where uncertainty is having a negative effect on activity, but putting pressure on prices, then this implies a challenge for monetary policy. And additionally, if it affects the flexibility of prices, then it's going to influence, affect negatively the effectiveness of monetary policy. And indeed, there is evidence that monetary policy is less effective in times of uncertainty. So I think our paper is empirical, but I think the theory discussion is interesting to motivate the study. The main theories that imply that uncertainty can be deflationary are based on its negative effect on aggregate demand, or a mechanism that goes through precautionary savings channels, and there are some papers here. But even these papers are, the models in these papers, the results can change depending on monetary policy, and the authors themselves make that point. And in contrast to this, there are many theories that imply that uncertainty can be inflationary. So there are theories based on an insurance mechanism of firms. They increase prices because they're uncertain of what's going to happen, and that's sort of an insurance mechanism. Theories that talk about customer capital, where customers are some sort of investment, and when there's uncertainty, you want to invest less, and that implies that you care more about your stock of customers in the future. And that's another theory. Theories about rational inattention, where firms take advantage of the uncertainty to increase prices and so on. So we think that discussion of theory is interesting. And then, so we use microdata underlying the consumer price index for Chile. And what we do is how different measures of uncertainty and risk are related to prices, to inflation of prices at the product level. We take these variables from the National Institute, and then we compute ourselves for each product statistics about the frequency of changes in prices, positive and negative price, the frequency of positive and negative price changes, and the intensive margin, that is the magnitude of the price changes. And throughout our paper, we also carry out the analysis with the exchange rate because it's interesting in itself, but also it might be related to uncertainty and risk. And then we do other work that we're not going to discuss today, but it's in the paper. So our main results are that we find positive and quantitatively important impact on prices. By quantitatively, what we do is standardize our variables of interest and compare it to the effect of the exchange rate. We get a pass-through for the exchange rate that's in line with the literature, and we say, okay, our variables, one standard deviation in any of our variables has quantitatively important results if we compare it to the effect of the exchange rate, which we think is itself important. No? So that's useful for comparison. And then the other point is, okay, is it through the intensive margin or the extensive margin? And we find that it's basically about the frequency of price changes. And this is in line with a literature, for example, authors like Nakamura, Steinson, Gopinath, papers that document that what fluctuates with the business cycle is the frequency of price changes. And so this is going to be in line, and we're going to show this graphically, and it's going to be quite, it's going to grab your attention when we see that. So what do we mean by uncertainty and risk? Of course, this is itself a topic of discussion, and there are many methods. Basically, here what we do is we take everything we can from the literature. People that study this have their series available online. They want people to use it, so that's good for us. And we use the EPU, which is the Economic Policy Uncertainty Index. People have widely used this. Then we use the Jurado, Ludvigson, and methodology. They have a series that are econometrically more sophisticated. So this is a different kind of index. We use volatility of the exchange rate and the stock exchange of Chile, the VIX for emerging markets. And then we have tried many other indices available. Like I said, people make these available on their websites, either because they're quarterly or we didn't find any significant results. We left them out, but we never found a result that goes against what we're showing today. So we do some initial analysis, graphical analysis. We find correlation with the indices. I'm going to skip that. But then when we look at the series, so for example, we have here inflation, and this is standardized, and we have the frequency of positive adjustment in prices. We find quite a bit of correlation with positive frequency of price changes and a negative correlation with negative price adjustments with inflation. When we look at the intensive margin, the size of adjustments, the correlation is very low. So this is already this is already in line with what I mentioned, that people find that what changes with inflation is this is more about the frequency than the magnitude. Firms change prices more often, but not necessarily they have bigger changes with higher inflation. And we do some initial, also for motivation, some local projections with aggregate inflation. And this is going to be in line with what defined with the microdata. We find that for the different indices, the effects here are standardized, so we can compare what happens with the exchange rate on inflation and the effect of the economic policy uncertainty. The Jurado and the co-authors, they have a similar impact, and so on. And then, but let me go to our main analysis here, which is using the micro level data. So we have product prices, monthly data from 2009 to 2018. We have 247 products that represent a large part of the basket. We have average prices for products, and then we compute the frequencies and magnitudes for varieties within each, different varieties within each product. And we use a standard set of macroeconomic controls. Like I mentioned, the exchange rate, we carry out that analysis in parallel because we think it's interesting in itself. Activity indices, monetary policy. Here we have tried with monetary policy shocks and the monetary policy rate and so on, but that doesn't change our results. And then we have our different indices of uncertainty and risk. We apply a standard specification. This has been called the long run pass-through regression, where we have variables in logs and first differences with a number of lags. So on the left-hand side, we have, for example, the change in prices or the change in the frequency of in positive prices and so on. On the right-hand side, we have the exchange rate, our measure of uncertainty, and all the other controls that I mentioned. And how the way we report our coefficients is as the sum of the coefficients. For example, the sum of the first 4 coefficients, which would be for the first 4 months, 6 months, 9 months, and 12 months. So I'm going to show a table, but I'm going to quickly go to a graph because it's better. But this is just to show you how we do it. So we run a regression only with the exchange rate. And here we have all the other controls, but we are not showing it. And then one at a time, we add only one uncertainty index at a time. So the exchange rate is in every single every regression, but what we are changing is the uncertainty or the risk index in each specification. And we have, I'm going to show you this graphically, just because it's nicer. And so this shows our results. The exchange rate pass-through is this line here. And then we have the other indices for uncertainty and risk. So since the variables are standardized here, these results are comparable. And so then we find that these different variables are important as well. And then we look at the extensive and intensive margin. And here what we find is that most of the action is in the frequency of price changes. So we find that these indices are associated with an increase in the frequency of positive price changes and a decrease in the frequency of negative price changes. And so we find this for our main specification. And for magnitude, here there's again no action, which is something we sort of anticipated by looking at the behavior of the magnitudes. There's not a lot of action here. So then what we do, this is sort of in the longer term. Here we're looking at a range of between 0 and 12 months, and we see at the beginning the impact is very small, and this starts accumulating in time. With on the intensive margin here, there's no effect, but we could look at also another specification for the short term. And here what we do is use linear probability models where we have the possibility of no change in prices versus any change, also no change versus positive changes, or no change versus negative changes. And here, again, with a standard set of controls, the same controls that we used before. And here we have, so we are doing this at the variety level. So we have quite a number of observations. And here again, we find that even in the short run, we have a larger probability of price changes, but more than that, it's a higher probability of positive price changes and a lower probability of negative price changes. So I think I went a little bit fast, but that's okay. That's going to be in the benefit of the other presenters. No one's going to complain about that. But so to conclude, we think again, so these results are important from the point of view of monetary policy. Again, if as the literature has documented, uncertainty negatively affects activity, and at the same time it puts pressure on prices, then this implies a challenge for monetary policy. And as we have seen, if it affects the flexibility of prices, then it's also going to influence its effectiveness. And indeed, in other work, there's evidence that monetary policy is less effective in times of uncertainty. Of course, there are many different channels. We're not arguing that our channel is the explanation, but it could be a part of that. So then the question, which is somewhat outside the scope of our paper, is, so there's empirical evidence that varies across different economies. And like I mentioned, even for the US or the UK or other economies, it varies over time. We have some discussion, like I mentioned, theories that point to the negative effect of uncertainty on prices are based on the effects on aggregate demand, or people want to save more, and so on. So if that mechanism is shut down, that maybe it would enforce the other channels. Then, so I mentioned at the beginning some other theories, and financial frictions could also be part of the story. But this is an interesting discussion, but it's not within the paper. So
okay,
yeah.
Thank you, Bernabe. So you finish like few minutes before the time allocated to you. So there is a few minutes for a quick question and quick answer. Anyone has any question for Bernabe? If not, I have a question. I'm just wondering whether you look at or you can look at the impact of uncertainty on the price adjustment of firms that have low level of debt versus high level of debt. So I would expect that price changes could be bigger or even more frequent for companies that have higher level of debt.
Yeah, so here, since this is CPI microdata, it's not linked to balance sheet information. So I know there's a paper by, it was Gilchrist and co-authors.
Yeah.
We're not able to go in that direction, but there's work at the bank obtaining prices that could eventually from the invoices of firms, and that could eventually be linked to balance sheet information, but that is not here.
Okay, thank you. So we can
I
move
think
to
there's a
the
question by Jorge.
yeah. Go ahead.
No,
Jorge,
just
quick
a
question.
short question related to Fabrizio's question, whether or not you can distinguish between products, type of products, and even seasonality of the data on your effects.
Yeah, so products, we divided, we did a couple of divisions, a couple of exercises, dividing tradables and non-tradables, and also services and products, which of course is very similar, and mostly the effects are larger for tradables. And event analysis we have not done, but another exercise was doing by different categories, and the results were similar to what I mentioned, that they were stronger for products and tradables. Thanks.
Okay, excellent. I think we should move to the second paper. Jorge is presenting. Jorge, the floor is yours.
Thank you very much, Fabrizio. Thanks the organizers for inviting me to present this paper, which is showing work with Miguel Melo. Of course, the opinions are ours and not necessarily the opinions of the Central Bank of Uruguay. We know that inflation expectations play a crucial role in modern monetary policy, and monetary authorities aim to anchor these expectations in order to achieve price stability. And inflation expectation might be affected by other variables on top of monetary one, for example, fiscal one. And this is the focus of our paper, how fiscal outcome and fiscal policy affects inflation expectation, and in turn affect monetary policy. So theory suggests that inflation expectations play an important role in transmitting fiscal consideration into inflation, but there is little empirical evidence, with the exception of Coibion, maybe, and others, which focus on inflation expectation by households in the US. And so we ask, what limit does fiscal policy impose on the achievement of monetary policy objectives through the inflation expectation channel? And we contribute some evidence for the case of Uruguay and for the case of firms' inflation expectations in Uruguay. And we use this unique data set containing systematic and quantitative monthly data on firms' macroeconomic expectation in Uruguay. The data set covers the period October 2009 to today, but we cut the sample just before the COVID-19 pandemic start. And we contribute this evidence of a positive association, a positive and robust association between the budget deficit to GDP and inflation expectation of firms. And this suggests an interdependence between fiscal and monetary policies, and in particular, monetary policy face more challenge to maintain inflation expectation anchor when the fiscal outcomes worsen. So this paper is related to several lines of literature. One is about formation of inflation expectations. The other is about the interaction between fiscal and monetary policies. And here there is a large literature about fiscal dominance. We do something different and more in line with work by Gelos and Rossi, which try to disentangle the effect of fiscal policy on inflation expectation, but in aggregate terms and for another period for a couple of countries. And of course, to the increasing literature of inflation expectations in Uruguay. In particular, I cite here two papers, but there are many others. Related to data, we use several sources. The main source is the inflation expectation survey, which is conducted to around 600 firms. And the sample is representative of the private non-financial firms in Uruguay with 50 or more employees. This is monthly data covering the period October 2009 to March 2020. And this gives us an unbalanced long panel with a total of 126 months and more than 40,000 observations. We use fiscal and macroeconomic data. The focus will be in fiscal variables like the budget deficit to GDP, but we use also government debt and other kind of fiscal variable. As to check a robustness, we check a lot of other macroeconomic variables like the foreign exchange depreciation and volatility, the GDP growth, unemployment rate, and others. To take an overview of monetary policy, we use the short-term interest rate as a proxy of the credit channel, the interest rate channel of monetary policy, but we also construct a monetary contractivity index, which is an index about the tone of the communication of monetary policy in Uruguay. As background, monetary policy in Uruguay is an inflation targeting regime since 2007, but there are two stages in terms of monetary policy management. From the start to June 13, it was the interest rate, the policy instrument, and it was changed in July 13 to the end of our sample. After the end of our sample, it changed again. And during that period, it was monetary policy aggregates the instrument. The inflation target was widening from 4.6 to 3.7. And the horizon of the monetary policy was also extended from 18 months to 24 months. And here I will be quick. It is the normalized short-term interest rate and the contractivity index. Positive values of the contractive index is more contractive monetary policy in terms of its communication. So you can see that during all the period, the stance in the term of the tone of the monetary policy is mostly contractive. Inflation was most of the time above the ceiling of the target, but one can say that there were anchored in some value between 8 and 10, which is outside of the ceiling, and inflation expectation also were above the range and close by the inflation rate. What about budget deficit? The primary result in terms of GDP was an increasing trend since the starting of our sample, from values around 1% in terms of budget deficit to values around 50% at the end of the sample. So going quickly to the empirical strategy, we conduct a series of models, but mostly with this, estimating this equation, where we have the inflation expectation of firms in the left-hand side, and well, the persistences of this inflation expectation in the right-hand side, the last observed values by firm of the inflation rate at the time of making the expectations and informing the expectation, the short-term interest rate, and the expectation of firms about the budget deficit, among other controls. there is no available information on the expectation of fiscal variables by firms. So we do the following. We use the trend cycle component of the last observed values of the deficit to GDP as a proxy. You have to note that in Uruguay, and I guess in almost all countries, the fiscal news are very important, and when there is a release of the fiscal deficit, the newspapers and all the news talk about that. Professional forecasters also, and so it's a very important variable together with inflation and exchange rate in the minds of price setters or firms in particular. So we use these variables as a proxy of the expectation of firms, but of course, fiscal expectation by firms might react at the time of an announcement or even at the time of some shocks to the economy, and this is before we can see the numbers in the official statistics. So we instrument this variable, the trend cycle of the last observed values of deficit to GDP, by the median of the expectation of professional forecasters, which are the only one expectations we can observe. The estimation method is a two-step GMM with robust standard errors. Inflation expectations are highly persistent, and so this method account for that. And we consider the endogenous variables, which are the monetary policy ones, short-term interest rate, monetary contractivity index, and also the budget to GDP ratio, are instrumented by the lags and the 12-month average of firm expected cost and inflation. And we introduce a series of controls, annual and monthly fixed effects, monetary policy range, and the instrument changes I referred to, and also the number of answers to the survey. Thank you. The number of answers to the survey, because well, this might also bring some information. And here there are the main results. In the first column, model M1, you can see a benchmark equation where we only put the expected the lag of the dependent variable, inflation rate, and the short-term interest rate, and we obtain the expected signs. And the main result is here in model 2, where we introduce the budget deficit to GDP, and we find this significant and positive coefficient, which says that bigger deficit imply bigger inflation expectation by firm. I should say it's correlated with bigger inflation expectations by firm. And this result is robust through all the specifications. What we do after is to account for interactions and to introduce other variables. The first thing is to contemplate the interaction between the short-term interest rate and the budget deficit, and we got this positive coefficient, meaning that the monetary policy through the credit channel seems not to be enough to compensate the effect of the budget deficit on inflation expectation. Then we assess the communication channel through this index, and we got a negative coefficient and significant, with in some sense is evidence that this communication channel is working. And interestingly, the interaction of the three, the interest rate, the contractivity index, and the budget deficit to GDP, turns out to be negative, meaning that monetary policy working through the two channels is able to compensate the effect of the budget deficit. Then we split the sample in two at the time of the change of instrument. We conducted this the same kind of exercise for the period from the start of the sample to 13, and then after. And what we can see is that the main qualitative results remain robust. In particular, those refer to the budget deficit. And here in the first period where the interest rate was the instrument, the interaction between the interest rate and the budget deficit turned to be negative, meaning in some sense that that monetary policy is more powerful than in the whole sum. There is a higher coefficient of the short-term interest rate. There is a lower coefficient of the deficit to GDP and a lower coefficient of the contractivity index, meaning that the interest rate is doing most of the work in terms of monetary policy during the period, and is compensating the negative effect imposed by the budget, the fiscal policy on expectations. Things are different in the second subsample, where the money aggregates are the instrument. There is a lower coefficient of the short-term interest rate. There is a higher coefficient of the contractivity index, meaning that the communication is more important. And it's a higher coefficient of deficit to GDP, imposing higher limit of fiscal policy through expectation, through monetary policy. So we conduct a series of robustness tests. We replace fiscal variables by others, like the primary deficit to GDP, the gross public debt to GDP, and we got the same message. We add other controls, macroeconomic controls, like the foreign exchange depreciation, foreign exchange volatility, GDP growth, unemployment, and the results remain robust. As to conclude, well, we contribute robust empirical evidence of a positive correlation between fiscal variables and inflation expectation of firms, and this determine an interdependence between monetary and fiscal policies. And in particular, what we think is that monetary policy faces more challenge to anchor expectations when the budget deficit worsens, and this is the evidence we provide. The interest rate channel of monetary policy working in isolation might not be enough to compensate the negative impact of fiscal policy on inflation expectation, but working together with the communication channel, it might be. The limits imposed by fiscal policy are larger after June 13, when the change of instrument and the widening of the range occurs, where the fiscal deficit was also larger, and well, the major monetary policy things occur. So this my presentation. Thank you very much.
Thank you, Jorge. I think there is time for a quick question. Any question for Jorge? I mean, I have one question on the channel through which you find this association between the budget deficit and inflation. I'm just wondering whether, so what is the channel? So is the exchange rate, for example, an important variable? So fiscal deficit, an increase in fiscal deficit might lead to the expectation of exchange rate depreciation, and therefore this could be one of the driver of higher inflation in the future. So just try to understand if there is any evidence on what is the channel for the results that you just shown.
Thank you, Fabrizio. Well, the volatility of the exchange rate tends to be an important variable. In the controls we do, it appears to be significant, but the budget deficit put in the equation continues to be significant, and with the same coefficient, more or less, than before. So we did not conduct a deeper analysis in the channels, but what I can say from these results is that the volatility of exchange rate is important, but itself fiscal deficit is important. And the conjecture here is that this is a very important variable in the mind of people, and in particular firms. It is, together with the exchange rate, together with inflation rate, is the budget deficit. Each month it appears, the FIGO is in the news, and a lot of people is talking about that. It's more or less a direct channel, I guess, of I could say it's like a summary measure of the strength of the macroeconomy, and in that case, the effect in inflation expectation is mostly direct, I guess. You are on mute.
Sorry. No, I would just say thank you for your answer. And if there is no other quick question, we can move to Javier.
I'll start sharing my screen. Can you see it there?
Yes,
Perfect.
we can see it.
So this is like a shift in focus, because this is a theoretical paper, and it's about alternative monetary policy instruments in context of limited credibility. So the motivation starts from two kind of contrasting observations. One is that if you read the literature on monetary policy rules, it seems to be heavily influenced by the development of IT, in that most people study instrument policy rules that has the interest rate as the instrument. And most of these papers work under a rational expectation framework. And even those relaxing rational expectation one way or another still focus on interest rate rules. But then when you look around the world, this is data from the IMF Exchange Rate and Monetary Policy Arrangement database, you see that only 23% of the countries have an IT framework, with the policy rate being the instrument. But then the rest of the countries are either money targeters, like around 12%. Most of countries have an FX anchor, and then some other or mixed arrangement. And these other type of instruments are mostly related with what happens with low income and emerging countries. Okay, and moreover, in those countries, it's not only that they choose some other target, but also there is significant amount of FX management in those countries. Okay, so it's kind of contrasting, because if you look at the literature, they just are talking to IT economists, but there is like the 75% of the world. And here I'm even excluding EMU members. Okay, so I started to think about this, and maybe what is one of the things that can be different in low income and emerging countries is credibility. Okay, so in particular, we know that in these countries, so credibility cannot be taken for granted. So the question I pose and try to answer in this paper is, if there is a way that if you work in an environment of limited credibility, that can influence the choice of the policy instrument. Okay, and in given that answer, part of the analysis, an important part of the analysis, is going to be a departure from rational expectation, because we know rational expectation implies a high degree of credibility in general, as agents are assumed to forecast knowing what is the policy rule that will be implemented in the future. Okay, so what I do here is I use as a laboratory education small open economy DSGE model, with one of the main features being limited credibility, which I capture by assuming adaptive learning in inflation-related variables. So basically, to forecast inflation, these agents are going to use a VAR with a time-varying long-run inflation expectation that is meant to capture anchoring in the same way that many people have done in the literature before. But the VAR is not only going to include inflation variables, but crucially, it's also going to include the effects, the exchange rate. So it's going to be the case that in principle, not only surprises in inflation can fed into long-run expectation, but also a direct channel through which effect surprises can lead into higher long-run inflation expectation. So in this setup, what I do is I study the dynamics after a war interest rate shock, say the country premium in all emerging countries is increasing, under three alternative simple rules. One is a Taylor rule for the interest rate, which is calibrated based on estimation of Chile. And then two simple rules, one for the money supply, is a constant money growth rate rule. And then a crawling peg or a fixed exchange rate, if you want, for the exchange rate. So the idea is to look at how the dynamics compare under this same shock with these three policy rules and see whether that comparison is different depending on whether you have rational expectation or limited credibility. And I also conduct some welfare type of analysis to try to rank the three alternatives. Just to give you a preview of the results, if you just focus on rational expectation, there seems to be a trade-off between using the Taylor rule and a constant money supply rule. And the trade-off arises because I'm going to show you the money growth rule insulates activity somehow from the effect of this foreign shock, but at the same time is more inflationary than the Taylor rule. So there is a trade-off there. With the crawling peg, this is the typical result. There's a larger recession and there's no clear inflation advantage, so the peg is dominated for sure. And I have two cases of limited credibility. One where only inflation surprises affect long-run inflation expectation, which is basically the channel that most people in the learning needs to have emphasized. And I show that we have qualitatively similar trade-offs, but differences are exacerbated just because learning induces more persistence. Okay, so this was to be expected. But the thing that is kind of new is that if limited credibility features a channel through which effects surprises can also affect long-run inflation expectations, then we are going to see that there's less insulation from the money rule. So it's less clear the potential advantages of using the money supply. But what is going to arise is a potential role for exchange rate stabilization. Yes, because by stabilizing the exchange rate, you are going to prevent this additional anchoring channel. Okay. So the model is kind of a standard DSG for a small open economy. It features free capital mobility and incomplete financial markets. You have households that consume subject to habits. There is labor supply, they demand money, and also foreign and domestic bonds. There is a production of home goods that is done by labor and combining labor and capital. And then there are final goods that are those that are consumed by household that is a combination of home and foreign goods. And we have Calvo prices and indexation. So there's a price Phillips curve. We're also going to have a dominant currency pricing environment following the recent literature, which limits the expenditure switching channel. We also have a sticky wages a la Calvo, also with indexation. And finally, there is capital accumulation subject to adjustment cost. Okay, so where in the model are inflation-related expectations relevant? Well, in two places. One are Phillips curves. So Phillips curve says that current inflation depends on the expected inflation. Okay, but then also in terms of intertemporal choices like consumption and investment, because the relevant rate for these decisions is the short-term nominal rate minus inflation expectations. So if there is something different than rational expectation, it's going to also alter the choices of consumption, investment, etc. What I'm going to be looking at is, as I was saying, like a war interest rate shock or a country premium shock that is calibrated just to have the number of the average MB for Latin America is a positive shock with a persistence of around, with a half-life of around 5 quarters. Okay, so the key ingredient here is how the learning is going to work. And as I was saying before, basically price and wage inflation expectations are determined by an empirical model. But these guys may not have rational expectation, but they went to macro classes somewhere and they know that the exchange rate influences inflation. So basically they run a VAR in which they have inflation the change in the nominal wage and the change in the exchange rate, and they run a VAR that has a time varying constant, alpha, and alpha here is a scalar. So basically it means that in the long run, there is a common trend that is going to move inflation, wages, and exchange rate, as we should expect in most models in the long run. Okay? So they have to infer this constant trend, and they do so by a constant gain Kalman filter. And the key difference here with other papers in the literature is that there are three parameters that are relevant for the learning dynamics. So on one hand, inflation surprises can affect this long run trend, and this is the parameter K pi. Wage surprises can affect this long run trend, and this is KW, and also exchange rate surprises can affect that. So we are going to have two channels. One that is the people almost elsewhere with learning dynamics have emphasized, which is the persistence. If you have inflation today, more inflation than expected, that's going to feed into long run expectations, and this is coming from this K pi and KW. But then the other component is this FX channel. So surprises in the effect can have can affect long run inflation expectations. So basically I need how to parameterize these three variables. And what I do is I estimate this simple VAR with time varying trend for two different countries, Argentina and Chile, which are going to save as a country with low credibility versus one with more credibility, and this in relative terms. And then one is estimated using core inflation, nominal wages, and FX depreciation, but also includes information from market expectations in terms of inflation and depreciation. Okay, so the model has many parameters, but here I'm summarizing some results. One is that the first thing is that if you look at Argentina, around the variance of this trend represents around 14% of the variance of total inflation, whereas in Chile, this is just 3%, and it's almost non-significant. So clearly the model can tell apart the story of limited credibility through an anchoring and movements in long-run inflation expectations. When you look at these K parameters for inflation and for wages, you obtain values around 0.2, 0.15, which are close to those that people use in the literature. But when you go and look at the parameter for the exchange rate, you obtain almost nothing. And this was kind of surprising. So the thing, my interpretation here is that you're trying to capture like the average with this model, is like the average influence of exchange rate surprises. So you are mixing little surprises with big surprises. Okay, so maybe there's no linearities in this. And to look at whether this is the case or not, here I'm plotting in the horizontal axis the exchange rate surprise, how the exchange rate this month was compared with what people expected for this month last month. And then on the vertical axis, the change in 12 months ahead inflation expectation. And what you can see, if you put all the points together, the relationship for both countries is not significant. But in the dots in red are those that satisfy that are bigger than one standard deviation. So you can see that for Argentina, when you have a large exchange rate surprise, inflation expectations move significantly. Whereas for Chile, you don't have that channel. Okay, this is negative, but it's not significant once you run the regression. So I'm going to explore two calibrations. One in which the exchange rate channel is not open, so this KS is equal to 0, and then the other one in which is open and it has a value that is the same as the other two. Okay. So here what you have are the input responses to a world interest rate shock under rational expectation. In the top of the panel, you have GDP, consumption, and investment. In the middle part, inflation, inflation expectation, and the real rate. And in the lower part, the exchange rate, the policy rate, and the nominal growth of money. Okay. And you have three lines. The blue line is under the Taylor rule. And then you have the typical result that one should expect. An increase in the foreign interest rate leads to a contraction in the economy and a depreciation, and given that, more inflation. That's the blue line, okay? And the Taylor rule dictates that you're going to increase somehow the policy rate, and you are trading off inflation on one hand and the contraction in activity on the other hand. Once you have a money rule, that is the red dotted line, in the money rule, there is somehow an insulation in terms of activity. And why is that? Because the interest rate endogenously falls once you have a constant money supply. And that is going to provide some insulation for consumption and for investment. But on the same hand, you also have more inflation and more inflation expectation, of course. And the nominal exchange rate depreciates even further, because if the foreign interest rate is going up and the domestic is going down, interest rate parity dictates a higher depreciation. And then the black line is the typical Mandel-Fleming fixed exchange rate result. You have more contraction in activity, okay? And inflation goes down, but you have more persistence, so it's not obvious that you're decreasing volatility. What happens if we do the same thing, but under learning, when we don't have the exchange rate channel, just the persistence? Well, the responses qualitatively are the same as we had before, but we have more persistence. Why? Well, inflation expectations increase by more, okay? And they remain above zero for a longer period of time. So that's going to feed into more persistence in all the variables in the economy. But kind of the relative ranking, at least in terms of the input responses, it's not that different. But 5 minutes, okay. When we go to the third type of the second type of learning, when you activate this exchange rate channel, okay. So there, the result change somehow. If you look, you can see that the blue and the red lines are almost identical in terms of activity. And the reason is because under this type of learning, the inflation expectation increases by more, and it does so even more so for the money rule, because we say under the money rule, the exchange rate depreciates even further. So now this insulation that we used to have before is no longer as important, and both of the blue and the red lines are closer to each other. But then at the same time, the black line is also closer to the other two. Why? Because by fixing the exchange rate, you are limiting this additional learning channel or inflation-related expectations, and then in that way, you are providing some insulation with the peg, okay? So this is, I can show this is not only so in terms of input responses, but also in terms of welfare. Here, what I'm reporting is the welfare equivalent consumption. And the rational expectation, the first line says, how much are you willing to give relative to live in a world with the Taylor rule if you have the money supply rule? And the rational expectation, you're actually better off with the money supply rule. The difference is less than 0.2%. And the welfare cost of the peg is much higher. It's like 1%, and it's almost 4 times as the in absolute value relative to the previous. Once you add the limited credibility, in terms of welfare, actually, you don't like that much the money supply rule as you did in rational expectation, okay? But the welfare cost of the peg is almost the same as under rational expectation. If you add this additional channel of exchange rate in inflation expectations, then you can see that the comparison between M and interest rate rules is almost the same, but the welfare cost of the peg reduces in almost by half, okay? So this is what I was mentioning before, that there might be some room for FX stabilization if you are concerned that the surprise in the exchange rate may feed into long-run inflation expectation. I conduct sensitivity analysis with other model features like financial frictions and liability dollarization, more limited expenditure switching, banks, two agents, one constrained, one unconstrained, and all combined. And the comparison is kind of similar. If anything, the presence of financial frictions induces a smaller cost of a peg, so it's relatively more important if you face financial frictions and liability dollarization because you have an additional real channel that plays a role there. Okay, so just to conclude, so basically, in general, under rational expectation and under the usual type of learning that people use, you have a trade-off between interest rate rule and money rules, and the peg is not desirable. But if you have this issue that the surprises in the exchange rate feed into long-run inflation expectation, first, there is the less obvious advantage of a money growth rule, and there might be potential benefits for FX stabilization, especially in the presence of financial friction. So I think I'm in time. I'm going to stop sharing. Thank you.
Yeah, perfect timing, actually. So is there any quick question for Javier? Okay, I have one clarification question. I mean, for me, from my understanding, so the rule that you are looking at are rules where you optimize the parameters.
No.
You find the, or you just how do you choose the parameter that enter in the rules?
No, I'm just using the only one that has parameters is the Taylor rule, and I'm calibrating those to what people have estimated for Chile.
Okay.
That's what I said. This is just an exploration. The next step will be to use optimal rules.
Okay. Yeah. Okay. I understand now. Okay. Thank you. So it is my turn to present. So just let me share my screen. Okay. Can you see my presentation, my slides? Okay. So let me see. Okay, so this is joint work with, so let me fix my slides here. So just a second that I try to see. Okay, so this is joint work with Ryan Banerjee and Aaron Merotra, who are economists at the BIS. With Juan Contreras used to work for the BIS when the paper was written. So what I'm going to show you today is a model that can be used to produce forecasts for inflation, not only for the most likely outcome, but for the entire distribution. And then I will show you the factors that drive, that can explain, influence the shape of the distribution, in particular the tails. But before I move on, let me stress the usual disclaimer. So whatever I say are my opinions, my views, not necessarily those of the BIS. So let me move
Maurizio,
to the.
we see all your screen rather than the presentation. So we see.
Can you see it now?
Yeah.
Can
better? Maybe you can.
You see only the slides?
Yes.
Or maybe let me see. Okay, so the motivation, I think I don't need to explain to this audience why the discussion inflation risk is important. This is clearly policymakers are clearly interested in avoiding extreme outcomes in inflation, and they also use they mentioned the discussion inflation risk in their communication. So despite how important inflation risks are, I think that inflation risks have been under research in the literature. For sure, there is a large body of literature that have investigated the variance of inflation or symmetric uncertainty, but relatively few papers have investigated the entire shape of the inflation distribution, including asymmetries, skews, or the thickness of the tails. And the papers that have done so are quite recent. And this paper are cited in the slide. And in addition, this paper focused on advanced economy, not on emerging markets. So on these slides, this slide shows that inflation distribution, forecast inflation distribution are, there is a great variability, so they vary significantly across countries and over time, both in advanced and emerging markets. And what we want to do is to, in this paper, is to analyze the factors that explain this variation. So what I'm going to present today is, I'll show you the model that we use for analyzing inflation risk, and then I will describe the factors that are most important influencing them. So let me turn to the description of the model. So some of you may already be familiar with the GDP at risk framework. So the IMF views it in several of its publications, so you may have already come across it. And this is a framework developed by Tobias Adrian and other former colleagues at the New York Fed. The IMF has used it also for to forecast capital flows and other variables. And what we do here is to apply the same technique. So we extend the technique to a panel data setting, and we look at inflation. So one advantage that we have is that we have built a good database of inflation and other variables that span a large sample of advanced and emerging market economy. So the underlying model, so we took the specification of the model from an open economy Phillips curve, and then we look at also we augment the model with additional variable that capture the monetary policy framework and also capture the zero lower bound in advanced economy. And we also have an extension where we look at the impact of financial conditions. So more specifically, we ran a quantile panel data regression using as I said, an open economy Phillips curve as a starting point. And the econometric model is not a standard panel data model, but is a quantile regression model with fixed effects. The dependent variable that we want to forecast is inflation 4 quarters ahead. And the inflation is the year-on-year change in the CPI index. So the variable that we are using for forecasting are, as the one that are in the standard open economy Phillips curve. So we have a measure of economic activity. In our case, we use real GDP growth. We have current inflation. We have the log change in the nominal effective exchange rate and the change in the oil price. And once the model is estimated, we use it to forecast the main quantiles of the inflation distribution. Once we obtain these quantiles, we interpolate them to obtain a smooth distribution. In this case, we use a skew T distribution, which is quite flexible. Is a distribution that capture changes in asymmetry, changes in thickness of the tails, and so on. And a particular case of this distribution is the normal distribution. So once we obtain a smooth distribution, we can ask questions like, for example, what is the probability of deflation? What is the probability of inflation overshooting the target? So how do this probability change, for example, when the exchange rate depreciates, say, by 10% and so on. And for robustness, we also estimate the model using alternative measure of economic activity. For example, we use the output gap and the unemployment rate. And instead of current inflation, we use short-term inflation expectation. We also use the bilateral dollar exchange rate rather than effective exchange rate. And in general, the results are quite robust to this different variable. We also look at inflation 8 quarters ahead instead of 4. And again, most of the results are robust, but one issue is that the precision of the estimates tend to deteriorate quite quickly when you expand the horizon of the forecast. And the sample include 12 advanced economy, 31 emerging markets. The sample start from 1990. And for emerging markets, we have, for several emerging markets, we have quite short time series. So we try to use the panel data to increase the statistical power of the model. And we estimate the model separately for advanced and emerging market, because there are significant differences across these two groups of countries. So let me now turn to the main results. So here, so here we have on the horizontal axis, we have the quantiles. On the vertical axis, we have the coefficient, the estimated coefficients. And the blue line correspond to standard or less regression. The red line correspond to the quantile, to the coefficient corresponding to the quantile regression, and the dotted lines are the 90% confidence interval. So we can see from this graph that there are important non-linearities regarding inflation and GDP growth. So these variables, in other words, affect differently the quantiles of the distribution. By contrast, the change in oil price, the change in the nominal exchange rates have similar impact on all parts of the distribution. So let's take inflation on the left-hand side panel. We can see that the coefficient on the higher quantiles are much bigger than on the lower quantiles. So in other words, current inflation has a much bigger impact on upside inflation risk. So the current inflation, sorry, I got confused. Sorry, I was, let me restart again on GDP growth. So we have on the GDP growth, we see that sorry, I got confused again. Sorry, the inflation. So the inflation, you can see that here the coefficients are bigger on the upside inflation risk rather than on the downside. So in other words, the current inflation tends to move the center of the distribution to the right, but it also shifts the right tail of the distribution to the right by more. So in other words, the distribution tends to be skewed to the right when inflation rises. Now, if you look at the second panel, the GDP growth, so higher GDP growth here tends to raise average inflation, but the impact on the downside risk or the left tail of the distribution is bigger than on the right tail. So in other words, high GDP growth reduces downside risk by more than increases upside risk, and the distribution becomes narrower. Now, the change in the oil price and exchange rate have a very similar impact on all quantile, as I said before. So increase in oil prices increase inflation, and appreciation of the currency reduces inflation. So in other words, these two variables move the location of the distribution, but doesn't change the shape. Now, let's look at the emerging markets. Now, the results for inflation and GDP growth are quite similar. And for the oil price, the effect is also similar, but is estimated less precisely. Now, the key difference here is represented by the exchange rate. So here, a currency appreciation or depreciation tend to have a much bigger impact on the right tail of the distribution. In addition, the size of the effect, both on average, both on the average and the right tail of the distribution, is much larger in emerging market than advanced economies. In particular, the effect on the tail is 6 times larger. Now, this is consistent with the fact that exchange rate pass-through tend to be higher in emerging market than in advanced economies, and also with the fact that the exchange rate has an important influence on financial stability, why this is generally not true for advanced economies. So let me now turn to the other results. So here we examine also in an extension of the model, we examine what is the impact of a zero lower bound in advanced economy, and second, we look at whether inflation targeting matters or not for both advanced and emerging market economies. And in the first panel, we see the result for the zero lower bound. So here we can see that the coefficient is negative for the lower quantile, but is close to zero for the upper quantiles. So it means that a binding zero lower bound increases the downside risk to inflation. In other words, it shifts the distribution to the left and also make the distribution skewed to the left. And the second panel show the impact of not having an inflation targeting regime in an advanced economy. And here, as expected, the absence of inflation targeting affects inflation positively, but the effect is statistically insignificant. And then you look at the emerging markets. So this is a different story. So here, the absence of inflation targeting leads to higher inflation on average, and also has a greater impact also on greater impact on upside risk than downside risks. And finally, in our analysis, we also look at the importance of financial condition. So here, financial conditions are proxied by realized volatility of the stock market. And there are two reasons why we choose this variable. First, is the only variable that is easily available for all countries in the sample and for the sample period. And second, in the analysis of Tobias and other colleagues, realized volatility is the component of their financial condition index, to which GDP at risk is also most sensitive. Now, the important thing to notice here is that the tightening of financial condition have an impact both on the left and the right tails of the distribution. At the same time, it has almost no impact on average inflation or slightly negative impact in advanced economies. So, in other words, the tightening of financial conditions tend to widen the distribution of inflation. And in advanced economy, the effect of tighter financial condition is larger on downside risk than but in emerging market, the effect is almost symmetric. So what explains this? I mean, why we think this result is interesting? I think we think it's interesting because if you run a normal OLS regression, you would find that the financial conditions don't matter for inflation. So if you look at the blue line, is almost zero, statistically insignificant. But when you look at all parts of the distribution, then financial condition matters. So you wouldn't find this with a standard regression. Now, why we find this effect? So as to the downside risk, the intuition is that a tightening of financial condition may be associated with weaker GDP growth, and weaker growth in turn should lower inflationary pressures. As to the upside risk, the results here is consistent. We think is consistent with two things. The first is the price settings of firms. So if, for example, if firms are liquidity constrained, they may want to raise prices to be able to meet their financial obligation. For example, tighter financial condition could mean higher interest payments and hence the need for to charge customer more or raise margin to improve their cash positions. And the second reason is that tighter financial conditions are also associated in emerging market with a sharp. They could be associated with sharp currency depreciation, and this could lead to higher future inflation. So I think I'm running out of time, but what we also did, we did some additional additional robustness check. We check. We compare the probability of deflation for the US and the euro area with those derived from ocean prices, and the graph here compares the two series of deflation probability. So the two methodologies basically give us similar broad trends. Another things that we did is to use the two series to compute a deflation risk premium. So the premium is calculated as the difference between the option implied risk neutral probability and the estimate of the so-called true probability derived from our inflationary risk model. And here we show that the deflation risk is important in driving the negative correlation between bond and equity returns. So the table shows that deflation risk premium is positively associated with the bond returns, remain positive when we control also for the level of inflation or the deflation probability produced by the model. And also, in addition, the deflation risk premium is also negatively correlated with the excess equity return. So, this results is so the importance of the deflation risk premium is consistent with some academic literature showing that the time varying risk aversion is an important factor that amplify the negative co-movement with the bond and stock return. I mean, taken together, these findings suggest that the inflationary risk model that we estimated yield some reasonable estimate of deflation risk and this deflation risk premium. So I am coming to the end of the presentation. So I'll just let me just summarize, what our finding. But first of all, we observed that upside inflation risk, so the right tail of the distribution, have declined over time, thanks to successful disinflation and the adoption of inflation targeting. Second, inflation targeting is particularly important in reducing inflation risks in emerging markets. And third, the binding lower bound is an important factor increasing downside inflation risk in advanced economies. And finally, exchange rates and financial conditions are an important source of nonlinearity, especially in emerging market. In emerging market, currency depreciation increase upside risk, so skew the distribution to the right. And in addition, tighter financial condition in emerging market increase both upside and downside risk of inflation without having an impact on average expected future inflation. So before I conclude, let me also mention to you that we applied this framework to analyze the short-term inflation risk during the pandemic. So we have shown how the inflation risk have changed during the pandemic, and this is a work that has been published in BS Bulletin number 28. And now we are working also on a working paper where we extend this model to look at fiscal variables. We try to understand how fiscal deficits, level of public debt may change inflation risks. And we hope to get a working paper out by the end of the year. So thank you all for listening. We have. I think we have we have a few minutes before the end of the session. So I don't know if you want to ask any question regarding my paper or to the other authors, please. Okay, Javier.
Okay.
Okay, there was someone else. Please go ahead and then I ask.
Yeah. Who else want to ask a question?
I do, Ana Aguilar.
Okay. Okay, excellent.
Hi, Fabrizio. I was wondering, the application of this methodology, like to forecast inflation and its risks. For example, as I understand, the history of inflation in the time series is what we use to estimate the whole distribution and then imply the risk for the future. But what if you have a totally new environment for inflation, like the one we are having right now, that a similar situation is absent in the time series? So how trustful is like our forecast, taking into account the particular situation and where we are?
Yeah, so what we, so the sample start from 1990s. Okay, so not all emerging markets time series start from 1990, but for a good number of them, we have series that start in 1990s. For several emerging markets in 1990s, I think that the inflation was quite high and volatile, and so I think the sample cover also, it doesn't cover also the more recent period that has been quieter, let's say. It's also covered the 1990s that have been more volatile. And also we look at whether there is a structural break. So we look at whether we estimated basically subsamples. And so we didn't find the big differences in the coefficient. So here actually we pull the data, and so the coefficient that we get are coefficient that are identical across countries. So if you want to do forecasting of the individual country, we have to use these estimates that we come out of a panel data model. So maybe it's not ideal, for forecasting, but that's the best thing we can do.
Okay, thank you.
Javier? Sorry,
so,
I can. Yeah, go ahead.
I have actually like one suggestion for each of you. So for Bernabé, I think that it will be interesting to analyze the link between uncertainty effects and then the price changes and the distribution, etc. Because I know that you are analyzing them like in separate terms, like you have the pass-through and then you have uncertainty. But what if uncertainty works through the effect channel? I think you mentioned that you have done some exercises comparing tradables and non-tradables. Maybe that's the place to start. But I will argue that's an interesting avenue. Maybe an interaction term in the basic regression, maybe something more sophisticated. But I think that could be important. For Jorge, I have a suggestion that is a complementary exercise, that why don't run like the regressions in differences, because here to me it's like a level effect. It's like average inflation is associated with average deficit, particularly because you are taking the trend of deficit. So it's like you're analyzing like the co-integrating relationship between the two. But maybe there is a complementary question that if you have like a sudden jump in the deficit, does that changes the long run expectation or not? And so maybe that's a complementary exercise. And then finally for Fabrizio, I think I always kind of lost in these quantile regression things, because you're trying to capture the whole distribution, but then things move together, right? So maybe a complementary exercise is to do like a scenario analysis, to say, okay, let's say inflation rises, but output is also rising and monetary policy is being contractionary. What is the shape of the distribution, and contrast that with like the average or things like that. Because when you say, okay, when GDP increases by more, well, that's a different effect on the tail or on the mean. Well, at the same time, inflation can do different things. So I think that would be like a nice complementary analysis.
Yeah, let me answer quickly to your question. Actually, for the sake of time, I didn't show how we actually effectively we use the model, but effectively the type of scenario analysis that you just mentioned. This is one example. For example, here we used to forecast the the distribution based conditional on the variable that we know. So in this example, we have Q2, Q3. Then we look at what is moving the composition, the contribution to the various parts of the different variables to different parts of the distribution. We have the left tail, the median, and then the right tail, and we get more insights from this type of analysis. And we can also do like other things equal ceteris paribus type of analysis, where we move one variable at a time, or we move more than one variable at a time. So for the sake of time, actually, I didn't show this, but yeah, definitely this is what we want to do. So I can see that Luis Rojas has a question. So I suggest that after he asks his question, I give the floor to the other presenter to respond to your comments. Luis?
Yes, do you hear me?
Yes.
Mauricio, is a question about your paper. I was wondering how important could it be endogeneity this setup? Because I'm wondering if I'm an European economy and I expect I have a large downside risk on inflation, this could take me to a zero lower bound. So it's precisely the downside risk that forces me to hit the zero lower bound. So I could make a similar story with financial constraints or financial conditions. So I was wondering if there is a way to assess this or not in your setup.
Yeah. This is the kind of I would say reduced form type of analysis, a forecasting exercise, effectively. So we are not looking at the endogeneity. So it's similar to like is similar to a local projection. So we take the variables today, and then we look at how they are. So we regress inflation 4 quarters ahead on variables today, but instead of doing the standard local projection, we run quantile regression. So it's effectively is a forecasting exercise, and then we report what factors are important in predicting inflation in the future. But we are not looking at the endogeneity per se.
No, I just meant it because the interpretation changed quite a bit
No,
in the
no,
sense of if the zero lower bound causes downside risk, or is the other way around. Yes.
Right. Okay. Bernabe, you want to answer the comment by Javier?
Sure. So we tried the interaction term. I remember we had some results, but I should go back to that, and maybe we can talk about. I think there was another comment later. Thanks, Javier, and everyone for the comments.
Jorge?
Yes, thank Javier for the comment. I need to think a bit more about your proposal, but it's worth to investigate. I will say something that Rodrigo Lluveras, who is in the room, but also tell me in private, it could be important. It's a surprise about the fiscal deficit, but we have no data for that. So that makes the modeling differences a bit tricky, a bit difficult to estimate. But we can continue thinking about it. And also thanks to Bernabe that suggests me in the chat to add the ENVI country risk, for example, in the regulations as controls. Some of these external effects should be through the foreign exchange, but it's worth to control for that variable. Also, thank you very much.
Okay, excellent. So I think we came to the end of the session. We ran out of time. I guess we can keep in touch and exchange emails. We have further comments on our paper. So I personally want to thank you everyone for making this session successful and for the comments. And I want to thank you everybody for attending. And I welcome any comments you want to send to all participants. I invite all participants to send comments to me and to the other presenter if they wanted to. These are absolutely welcome, and I'm sure they will help us to redraft our paper. So thank you, everyone, and well, let's keep in touch, given through email or other means, given our common interest. And yes, I wish you a great continuation of the day. Thank you very much. Bye bye, everyone.
Thank you all.
Thank you.
Thank you all.
Thank you.
Stay in touch.
Bye.
Bye bye.
Bye-bye.
Bye.